Using margin is one of the easiest ways to accelerate your stock market returns, but it can be dangerous if not used properly. So today we're going to discuss exactly how and when you should use margin in order to achieve the best results. My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So in case you're not familiar, margin is basically just money that you borrow from your brokerage in order to purchase stocks. So for example, let's say that you have an account where you've deposited $100,000, and if you're approved for margin trading, your brokerage would allow you to invest up to about another $100,000 on top of that. So that means that you could actually buy $200,000 worth of stocks even though you only deposited $100,000. Now of course you don't actually own that additional $100,000, but if you use it to buy stocks and then those stocks rise in value, or if you sell covered calls against those stocks to collect premium, you do get to keep all of those gains. But using margin also comes with increased risk, especially when not used properly, so there are a few things that you need to consider before using it for yourself. The first is, again, that using margin increases your risk level. And that's simply because you're borrowing money. So if you buy stocks using that money and then those stocks decrease in value, you still have to pay back the full original amount. Now, as we all know, in the long term, the stock market should always increase in value, but there's also bound to be volatility and temporary downturns along the way. So as we'll talk about shortly, it's very important to use margin responsibly. Because even though it can accelerate your returns, it can also get you into trouble in the short term if you're not using it properly. Then the other disadvantage to using margin is that since you're borrowing money, you do have to pay a bit of interest on it. But luckily that interest tends to be pretty low, usually between 2 to 8% annually depending on your brokerage. And so if you're using that margin to sell covered calls, your returns will far outpace the interest that you'll be paying. And a lot of the time you can even negotiate with your brokerage to get a lower interest rate. So for example, TD Ameritrade's interest rate is generally around 8%, but I was able to get it down to about 5% with just a simple email. So even with both of those factors in mind, I still think it's worthwhile to use at least some of your available margin. Because again, assuming your gains are outpacing your margin interest rate, really the only concern with using margin is making sure that your stocks don't drop in value to the point that you get a margin call. But if you're using margin responsibly, as we'll talk about in a minute, that's not really a concern either. But before we get there, in case you're not familiar, a margin call is when the amount of margin you're using exceeds the amount that you're allowed to use. And in that situation, you'd either need to deposit more money into your brokerage account or sell some of your stocks at a loss in order to pay your broker back. So again, that's really the only situation that you need to avoid when you're using margin, and there are a few things that I like to do to protect myself against that situation. The main thing, as I've mentioned in many of my videos, is to always use less than 40% of my available margin. Because as long as I do that, my holdings would need to drop by more than 40% in value before I'd be at risk of getting a margin call, which is pretty unlikely to happen. But it's certainly not impossible, and everyone has a different risk tolerance, so you may even want to use less than 40% of your available margin. And when you're trying to calculate the percentage drop that you can tolerate, the math can actually get pretty confusing since your available margin fluctuates based on your account value. So I actually made up a spreadsheet that you can use to determine what level of margin you're comfortable with using. So we'll just say we're working with a $100,000 account to make the numbers easy. And with most brokerages, your available margin will be equal to your account value, but that's not always the case, so you can just enter your available margin right here. Then the spreadsheet will automatically fill in the table and chart so you can see what percentage drop you can tolerate based on the percentage of margin that you're using. And keep in mind that this is the percentage drop of all of your holdings, including the ones that you've bought on margin. So it essentially equates to a percentage drop in the market. Because remember, the increases and decreases in your account value will be accelerated when you're using margin, so it makes more sense to look at the total value of your holdings in this case. But anyways, we can see here that if I'm using 40% of my available margin, I could tolerate about a 43% drop in market value before I'd be at risk of a margin call. So in other words, the total value of my holdings, including margin, would need to drop by 43% before I'd either have to deposit more money or sell some of my stocks. And likewise, if I'm using 50% of my available margin, my account could only withstand a 33% drop. If I'm using 30% of my margin, my account could withstand a 54% drop, and so on. So I always aim for 40%, and of course there are times when I use more than this, for example when I set up a naked call and end up having to buy the shares, but I always aim to use less than 40%. Then the other main way that I protect against a margin call is just by carefully choosing the strategies that I use and by only using them on solid stocks. So if you're watching this channel, you probably know that my main strategy is covered call writing, and I prefer to sell covered calls on mostly solid Dow stocks, or at least companies in the S&P 500 with solid fundamentals. But aside from that, I also sell naked calls, and in particular I use those to collect additional premium when the market is more neutral or downward trending. And I sell naked calls rather than selling puts as many people do, because when I'm selling naked calls, I only have to buy the stock if it rises, whereas when you're selling puts, you have to buy the stock as it's falling. And buying stocks as they're falling is the last thing you want to do if you're trying to avoid a margin call, because if the entire market starts to dip, not only will your available margin be decreasing as your account value decreases, but the percentage of margin you're using will also be increasing as you buy more stocks. So if you're not careful, you can very quickly end up in a situation where you've bought more stocks than you're allowed, and you'll end up getting a margin call. And by the way, if you're not already familiar with my strategy around selling naked calls and want to check it out, I'll leave that video linked below. Then finally, to protect myself even further, I also keep a separate savings account with cash in it, which I think is always a good idea, but it's especially important if you're using your brokerage account for income, because you never want to withdraw money from your account while it's down in value if you don't have to. So instead, when the market is down, you can withdraw from your savings account if you need money, or if you do get a margin call, you can just use the money from your savings account to fulfill your margin requirements if you feel comfortable doing that. Now, some people will also ask, why not just buy more options or use poor man's covered calls instead of using margin? Because these are all essentially just different forms of leverage. But the reason I prefer to use margin is the same as the reason that I prefer regular covered calls over poor man's covered calls, and that's due to the time decay aspect of options, along with the fact that the values of options fluctuate with volatility in the market. So when you're buying options, there are a lot of factors at play, because you have to worry about time decay, you have to think about the delta and expiration date, you have to consider volatility in the market to decide whether or not it's a good time to be buying options, and so on. Whereas with margin, as long as I stay below my goal percentage, I don't have to worry about anything else, and I know exactly what kind of market decline I can tolerate before I really start to see any negative consequences. So now again, if you want to learn my strategy around selling naked calls, be sure to click that video in the bottom right corner of the screen. I'll talk to you all in that next video.